Did you know that Warren Buffett follows two simple rules when it comes to investing? The first is, don't lose money. The second is, don't forget the first rule. It may sound obvious, but this philosophy was the key to him becoming one of the richest men on the planet. And here's the secret. He didn't get rich overnight, nor did he inherit a fortune. He did it by consistently winning in the stock market smartly and strategically. Now imagine the power of having these two rules as the foundation of your financial life. How could they transform your journey in the world of investing? Think about it. Buffett started in a way few people imagine. He wasn't a tech genius or a big business tycoon right away. When he was a child, he sold Coca-Cola door to door, simply to earn some extra money. But what makes Warren so fascinating is the fact that he knew how to apply these rules in a way that few could see. He didn't buy stocks because they were trending or because everyone else was doing the same thing. He bought when he believed the value was much higher than the price paid for them. This meant he was buying something below its real value, which in itself is a successful strategy. You might be thinking, okay, but how did he get there? Well, Warren was born in Omaha, Nebraska in 1930, 1 year after the Great Depression hit the United States. This shaped the way he saw the world, especially the value of money and the strategy to preserve and multiply it. During his childhood, he already understood that he couldn't rely on a future of wealth without putting in his own effort. So, as a curious and focused boy, he began developing solid financial thinking, which soon led him to make his first stock purchases at age 11. But the most interesting thing is that he knew how to learn from his mistakes, and when he made them, he didn't quit. He used that as fuel to improve himself. Now here's the big question. How can you learn from his mistakes and apply that to your own financial journey? When the market is unstable, when opportunities seem scarce, it's time to remember Buffett's words. Don't lose. Many investors, especially beginners, panic when prices drop. But if you follow these two rules, you protect yourself. Warren didn't get rich by taking unnecessary risks. He got rich because, in addition to buying at the right price, he knew how to wait for the right moment to act. What's most impressive about Buffett's journey isn't just the wealth he built, but how he built it, facing adversity and knowing when to take the next step. Each decision was a learning opportunity. The question is, what are you doing today to learn more about the investment market? Are you looking for strategies that really work? Are you willing to not follow the crowd, but to trust your own vision? If you truly want to achieve the level of financial success Warren Buffett has, start with these two simple yet powerful rules. Don't let yourself be driven by impulses, and always seek the real value behind each investment. As your learning journey develops, make an effort to apply these concepts to your own personal and financial growth. Remember, opportunities don't appear by chance, they come to those who are prepared to seize them. Now, if you're ready to change your mindset and take the first step toward your financial success, subscribe to the channel and like this video. Stay with us because this is just the beginning of your journey towards financial freedom. Let's learn more, grow more, and maybe, who knows, become great investors like Warren Buffett. Did you know that Warren Buffett follows two simple rules when it comes to investing? The first is, don't lose money. The second is, don't forget the first rule. It may sound obvious, but this philosophy was the key to him becoming one of the richest men on the planet. And here's the secret. He didn't get rich overnight, nor did he inherit a fortune. He did it by consistently winning in the stock market smartly and strategically. Now imagine the power of having these two rules as the foundation of your financial life. How could they transform your journey in the world of investing? Think about it. Buffett started in a way few people imagine. He wasn't a tech genius or a big business tycoon right away. When he was a child, he sold Coca-Cola door to door, simply to earn some extra money. But what makes Warren so fascinating is the fact that he knew how to apply these rules in a way that few could see. He didn't buy stocks because they were trending or because everyone else was doing the same thing. He bought when he believed the value was much higher than the price paid for them. This meant he was buying something below its real value, which in itself is a successful strategy. You might be thinking, okay, but how did he get there? Well, Warren was born in Omaha, Nebraska in 1930, 1 year after the Great Depression hit the United States. This shaped the way he saw the world, especially the value of money and the strategy to preserve and multiply it. During his childhood, he already understood that he couldn't rely on a future of wealth without putting in his own effort. So, as a curious and focused boy, he began developing solid financial thinking, which soon led him to make his first stock purchases at age 11. But the most interesting thing is that he knew how to learn from his mistakes, and when he made them, he didn't quit. He used that as fuel to improve himself. Now here's the big question. How can you learn from his mistakes and apply that to your own financial journey? When the market is unstable, when opportunities seem scarce, it's time to remember Buffett's words: don't lose. Many investors, especially beginners, panic when prices drop. But if you follow these 2 rules, you protect yourself. Warren didn't get rich by taking unnecessary risks. He got rich because, in addition to buying at the right price, he knew how to wait for the right moment to act. What's most impressive about Buffett's journey isn't just the wealth he built, but how he built it, facing adversity and knowing when to take the next step. Each decision was a learning opportunity. The question is, what are you doing today to learn more about the investment market? Are you looking for strategies that really work? Are you willing to not follow the crowd, but to trust your own vision? If you truly want to achieve the level of financial success Warren Buffett has, start with these 2 simple yet powerful rules. Don't let yourself be driven by impulses, and always seek the real value behind each investment. As your learning journey develops, make an effort to apply these concepts to your own personal and financial growth. Remember, opportunities don't appear by chance, they come to those who are prepared to seize them. Now, if you're ready to change your mindset and take the first step toward your financial success, subscribe to the channel and like this video. Stay with us because this is just the beginning of your journey towards financial freedom. Let's learn more, grow more, and maybe, who knows, become great investors like Warren Buffett. At the age of 14, Warren Buffett was already showing signs that he wouldn't be an ordinary person. Instead of waiting for opportunity, he went after it. He started his first real job delivering newspapers for the Washington Post. But when he realized he wasn't earning what he wanted, he didn't sit still. He decided to take another job with a competitor, the Times-Herald, and started delivering newspapers for both, earning $179 per month. For the time, this was a significant amount, over $3,000 in today's money. But that wasn't the only thing that set him apart. Warren had a sharp sense of opportunity. He used the money he earned to buy an arcade machine with a friend. They placed it in a barbershop and soon realized that fun could be very profitable. With success, they bought more machines, shared the profits with the barbershop owners, and in the end, sold all the machines for $1,200. The big turning point? Warren used this money to buy his first property, a 40-acre plot of land in Nebraska. And the most impressive part is that he was only 15 years old when he did this. Just think about it. He was already building an empire even at such a young age. This is a true demonstration of vision and focus, which makes you wonder, am I seizing the opportunities around me with the same strategic mindset? After finishing high school, Warren was determined to pursue a career as a stockbroker, but his father had other plans. Instead of following his intuition, Warren enrolled at the University of Pennsylvania, using the money he earned from renting out his property to pay for his studies. After completing his undergraduate degree, he decided to apply for a master's program at Harvard. But upon being rejected, he likely felt a huge disappointment. However, instead of getting discouraged, this rejection ended up being one of the greatest blessings of his life. Warren went on to attend Columbia Business School, where he had the fortune of meeting Benjamin Graham, an economist and investor who would change his life forever. Graham, who had just published one of the most important books of his career, The Intelligent Investor, became a mentor to Buffett. Warren followed Graham's principles with total dedication, understanding that the secret to investment success wasn't speculation but buying undervalued stocks of good companies and holding them for the long term. If you've ever thought about following the proven strategies of successful investors, see what Buffett learned. Focus on the long term and strong companies. When Buffett completed his master's degree in economics, he was ready to start his career on Wall Street, close to the major investment firms and the New York Stock Exchange. But what many don't know is that, despite all his experience and knowledge, Warren was still extremely introverted and had a fear of presenting himself to new people. He was terrified of public speaking, and often his nervousness would make him physically ill. This may seem strange considering the success he later achieved, but in reality, this is what makes Warren Buffett's story so inspiring. Despite these insecurities, he didn't stop. He overcame his difficulties and became one of the world's greatest investors. And here's the lesson: what's holding you back from moving forward? What obstacles are you facing on your financial or personal journey? Warren Buffett teaches us that, no matter what happens, the important thing is to take action. Start small, learn from your mistakes, and above all, don't let your fears defeat you. If Warren could overcome his personal limitations and build an empire, you too can achieve your goals. Now, what will you do with the opportunities ahead of you? Let's learn together from the mistakes and victories of those who have already paved the way to success. If you're ready to learn more and grow on your own path to financial success, subscribe to the channel and like the video. The road to prosperity starts with action, and the first step is being willing to learn, grow, and overcome. What would you do if, at 21 years old, you had an enormous opportunity ahead of you, but at the same time, a paralyzing fear of not being able to seize it? Sounds tough, right? Now imagine Warren Buffett, a 21-year-old with the world of finance in his hands, but with a huge obstacle: the fear of public speaking. Instead of letting this insecurity dominate him, he made a decision that would change the course of his life. He enrolled in a public speaking course, and this decision would prove to be one of the best investments he ever made. The lesson? Investing in yourself is the best thing you can do. The more you learn, the more you earn. Buffett did exactly that, investing in his own development, and soon after he began to reap the rewards. This choice not only helped him overcome his fears but also brought him a great opportunity. Benjamin Graham, the investor Buffett admired so much, reached out and offered him a job at his investment firm in New York. The offer was a milestone. Buffett, with his sharp mind and unique vision, quickly established himself in this new environment, mastering the art of security analysis and learning how to see the true value of a company based on its financial statements. But here comes the crucial point. Although he shared a deep respect for Graham, their philosophies were different. Graham was focused on numbers and cold analysis, while Buffett had a broader approach, believing that the company's management should be part of the investment decision process. He wasn't just looking at the numbers but trying to understand how and why the companies worked. This divergence in thinking led to a series of reflections and challenges, but it wasn't an insurmountable obstacle. Buffett continued questioning and learning, and this questioning would become the foundation for the success that followed. So what happened next? In 1956, at just 25 years old, Warren Buffett felt ready to take the initiative. He decided to start his own partnership, Buffett Associates Limited, with an initial capital of nearly $200,000, the result of his savings and experience accumulated in New York. The choice that stood out? Instead of renting a big office or hiring a team to start, Buffett used one of the rooms in his house, keeping costs low and focusing on efficiency. This choice demonstrates what many call an entrepreneurial mindset, where the most important thing is not showing that you have, but knowing how to use what you have to achieve what you want. More than that, Buffett turned every dollar invested into a long-term lesson, making his investors begin to earn fortunes, while he himself became one of the richest men in the world. Here's the big point. If you have the opportunity to invest in something that will help you grow, don't hesitate. Buffett didn't wait, he took the risk. When opportunities arise, invest in yourself, seek to learn, and above all, don't be afraid to question what everyone around you is doing. Just like Warren, you can turn your biggest fears into your greatest strengths. So, what will you do now to invest in your future? Are you ready to take the next step, even if the path seems challenging? Start by investing in your education, make bold decisions, and who knows, in the future, you might be building your own empire, just like Buffett did. Imagine this. You're at a point in your life where you're ready to take a big step, but you need support. Warren Buffett, with all his vision and accumulated experience, was ready to do just that. He managed to get some of his friends and family to invest a total of $105,000, a considerable amount for that time. With this capital, he started his partnership, the famous Buffett Associates Limited. But what did he do next? He didn't follow the traditional approach of investors. Influenced by his mentor Benjamin Graham, Buffett began investing in undervalued stocks, but he took this philosophy to the extreme. He went further, deciding that his goal wasn't just to buy cheap stocks, but to buy underperforming companies that were on the verge of bankruptcy. He bought them at such low prices that, even if the worst happened and the company closed, the liquidation value would still be higher. The strategy? Well, he called this cigar butt investing, a term that described picking up something that was about to be discarded but still had a last bit of value, like the final puff of a cigarette. Sounds bold, right? And that's exactly what he did. He sought out struggling companies that no one else wanted, bought them for a pittance, and restructured them to generate profit. He knew that in the market, those who can see value where others see only problems have a huge advantage. What can we learn here? Warren Buffett was radically different from most investors, and his strategy, though initially seen as risky, set him on the path to wealth. He wasn't afraid to look for opportunities where others saw failure. This is something that can be applied not only in the stock market but also in your personal and professional life. Sometimes, you need to look at what's around you, identify what many others discard, and realize that with the right knowledge and the right approach, even the most challenging situations can yield big rewards. Now let me ask you, have you been looking at your financial or professional life the same way? Are you seeing opportunities where others see difficulties, or are you waiting for things to change without taking action? The truth is, just like Buffett, you can also learn to see value where others see nothing. And the best part, you can start investing in your own knowledge and in the opportunities around you. Are you ready to take control of your future and turn those discarded cigars into big wins? The first step is to act. Invest in yourself, learn to see beyond the surface, and take confident action. If you're ready to start, subscribe to the channel, like the video, and start building your own path to success now. Imagine you find a cigar thrown on the ground. Strange, right? But what if I told you that this cigar still has one last puff of value? It might sound a bit absurd, but this is exactly what Warren Buffett did in the early years of his career. He called it cigar butt investing. That is, finding stocks so undervalued that, even though they were sold at liquidation prices, they still had hidden value. The concept is simple. You buy a stock at such a low price that even if it goes bankrupt, what you paid for it is still worth more than the market value. Then, you just sell the stock at an appropriate price, and the profit you make is almost like the last puff of a cigar, for free. And most importantly, this is what made Buffett's fortune grow exponentially. The result of this cigar butt investing method was surprising. In just 6 years, Warren Buffett managed to turn an initial partnership of $105,000 into nothing less than $2 million. This kind of radical thinking made him stand out in the financial market, but he didn't stop there. As his portfolio grew, more people wanted to invest with him, but here's the interesting part. Most of them didn't trust an 18-year-old kid to manage their money. And, in a way, they were right. Warren still looked like a teenager, even though he was in his late 20s, and for more than 5 years, he ran his partnership completely on his own, writing checks, making tax declarations, and receiving stocks. And that's where the story gets even more interesting. Despite all the initial distrust, those who bet on him reaped the rewards of a strategy that seemed risky but proved to be extremely effective. Investors who trusted Buffett between 1956 and 1969 had an average annual compounded return of 29.5%. To put it into perspective, that's over 4 times better than the stock market during that same period. And the best part? This was just the beginning. 10 years after starting his partnership, Buffett was managing over $44 million in assets. And just 3 years later, that amount shot up to an incredible $104 million. This is what happens when you know how to identify the right opportunities at the right time, even when the market looks at you with skepticism. Now the question is, How does this apply to you? In what areas of your life are you holding back because of the fear of being judged or not seeming experienced enough? Buffett was exactly that guy. No experience, no immediate confidence, but with a mindset that challenged the status quo. He found value where no one else was looking, and that vision is what made him one of the greatest investors in the world. Have you been looking for those opportunities? Are you willing to see value where others see difficulties? The secret here isn't what you have, but how you choose to use it to create something great. Are you ready to see your own undervalued stocks around you? Now is the time to act. If you're ready to take the next step, don't wait any longer. Subscribe to the channel, like the video, and start putting this success mindset into practice. Imagine being at the top of your game. Your portfolio is growing, your investors are happy, and the market is soaring. Sounds like every investor's dream, right? But what if I told you that, for Warren Buffett, this was a cause for concern? Yes, while his partners were celebrating the profits, he was analyzing the stock prices and making a different calculation. Buffett followed a principle that has guided him throughout his career. Be fearful when others are greedy, and greedy when others are fearful. Essentially, this is a warning for times of market excess when everyone is blindly buying. When optimism takes over, it's the perfect moment to be more cautious. That's right, while everyone else was excited about the rally, Buffett was wondering how long it would last. He knew stock prices were rising unsustainably, and sooner or later, the market would correct. For him, it was risky to continue investing his partner's money in such an environment, knowing that the market was at a point that couldn't sustain itself much longer. So what did he do? Instead of following the crowd and ignoring the warning signs, he made one of the toughest and at the same time wisest decisions of his career. At the end of 1969, Buffett dissolved his partnership. This move wasn't easy. Think about all the money he could have continued managing. But Buffett knew that the bigger risk was continuing to invest without a solid strategy. He preferred to shut down the business and let his partners go their separate ways, preventing them from losing more money in a market he saw as being on the brink of collapse. Buffett wasn't just thinking short-term, he was focused on protecting his investors' future, and this type of vision is what separates great investors from the rest. What can we learn here? Sometimes the biggest risk isn't investing, but continuing to invest when the market is filled with uncertainty. Warren Buffett proved that knowing when to exit is just as important as knowing when to enter. And this applies to all aspects of life, not just the financial market. Knowing when it's time to step back, rethink, and change direction is an essential skill, and you need the courage to act when most are being swept up by the wave of greed. Now think about what's going on around you. Are you making the right choices, or are you just following the crowd because everyone else is doing the same thing? The stock market is just a reflection of what's happening in real life. Sometimes the best choice is to stop and reflect to ensure you're not entering something that could in the end become a huge risk. And remember, the greatest fortunes don't just come from what you earn, but from what you avoid losing. So what's your next move? Are you ready to act wisely like Buffett, or will you let the fear of change dominate? If you want to learn more about how to make strategic decisions in times of uncertainty, subscribe to the channel, like the video, and start building your winning mindset right now. What will you do when the next market rally appears in your life? Imagine building a fortune of $25 million by the age of 39. Sounds impressive, right? But what Warren Buffett did next was even more impressive. He was ready to transform Berkshire Hathaway into a billion-dollar empire. How did he do that? The answer lies in how he handles moments of uncertainty. It's no secret that we live in challenging times. Inflation has reached the highest levels in 40 years, and nearly 70% of economists believe a recession is on the horizon for the next year. Now think for a moment, what would you do if you were faced with a scenario where most people only see a crisis? What Warren Buffett always did was see opportunities where others saw difficulties. He knew that moments of uncertainty aren't obstacles, they're actually the best chances to accumulate wealth. When the market is down, when everyone is worried, that's when the smart investor, like Buffett, knows it's time to act. Investors like Buffett have a rare skill. They know how to use fear and doubt to their advantage. While most investors run for the door when the storm hits, he stays calm and starts looking for the best opportunities. And what can we learn from this? In times of uncertainty, the greatest opportunity isn't in avoiding risk, but in knowing where to invest when fear is taking over. The secret is not allowing panic to take control, but instead using the wisdom gained over time to identify where others are going wrong. So, what can you do to follow this path? The answer lies in looking at the current scenario strategically. With high inflation and a potential recession ahead, you have two choices. Let fear paralyze you or prepare to act, just like Buffett. Investing isn't just about putting money into something, it's about doing it intelligently, in moments when others lack the courage. The biggest risk you can take isn't risking money, but not acting when the opportunities present themselves. Now stop and reflect. Are you prepared to take advantage of uncertain times and turn it into an advantage? Or are you going to wait for things to get better before taking the next step? If you want to learn how to build your own fortune, even in tough times, subscribe to the channel, like the video, and start putting this mindset into practice. The time is now, and the path to success is for those who know how to act when the market is down. Imagine you're faced with a scenario of high inflation, the financial markets are in turmoil, and you ask yourself, what should I do now to protect my money? Many investors freeze, unsure of how to react. Meanwhile, institutions like Warren Buffett's Berkshire Hathaway might already be well prepared. So, what do they know that most people don't? The answer lies in understanding where to allocate money when the value of cash is declining. One of the smartest strategies gaining traction is investing in real assets, like art. Now, you might be thinking, art, how can that protect against inflation? It seems unusual, right? But here's the crucial point. Art has proven to be an excellent way to preserve the value of money during times of economic uncertainty. Earlier this year, the chief strategist at Bank of America made a bold recommendation. He suggested that investors look to real assets like art to shield themselves from rising inflation. And it's not just speculation. Even Bloomberg reported that art can act as a hedge against inflation in almost any economic environment. This is because, during the last time inflation was this high, in the late 70s and early 80s, art saw an average annual appreciation of 33%, according to the Masterworks All Art Index. To put this into perspective, this outperformed gold and even real estate, the traditional safe havens during that same period. So, what does this mean for you? The answer lies in how you view your investment options. With art, you're not just buying a beautiful piece to hang on your wall. You're investing in an asset with the potential for impressive appreciation, especially when inflation is on the rise. One of the most innovative companies in this sector is Masterworks, which has made it possible for anyone to invest in multi-million-dollar contemporary art. Instead of being a market restricted to wealthy collectors, now any investor has the chance to protect against inflation and potentially make significant profits. What's even more interesting is that since its inception, Masterworks has sold 5 paintings with an average net return of 26.8% for its investors. This is an incredible performance, especially when compared to other traditional forms of investment. Art not only proves to be a great hedge against inflation, but it also offers a potential for appreciation that many didn't expect. So, what can you learn from all of this? It's not just about protecting your money. It's about having a strategic mindset, understanding that when the situation is uncertain, that's the perfect time to think outside the box. It's time to seek new opportunities, and art is just one of them. The financial market doesn't have to be a roller coaster ride. If you know where to look, you can find a way to protect and even grow your wealth, even in times of crisis. So what will you do? Will you keep following traditional strategies or seize the opportunities that many are overlooking? If you're ready to learn how to use real assets like art to protect your wealth, subscribe to the channel, like the video. and start exploring new ways to invest right now. The time to act is now, and you have the tools to turn the situation in your favor. Have you ever stopped to think that while many investors are panicking over the ups and downs of the market, there is an investment strategy that continues to bear fruit, even in times of uncertainty? The demand for smart investment opportunities like those offered by Masterworks is only increasing. Now, in a scenario of rising inflation and economic uncertainty, many people are looking for ways to protect and even multiply their wealth. And what's most interesting, Masterworks has already proven to be one of those opportunities, with consistent returns even when the markets are in decline. Now it's worth noting, past performance is not indicative of future results, but what we are seeing is a high demand for an asset type that has stood the test of time: art. And you can access this opportunity without having to wait in line. The link is in the description, and you can skip the waiting list to take advantage of it right now. But speaking about investing wisely, let's take a step back and look at an example that defines how a great investor thinks: Warren Buffett. When Buffett bought Berkshire Hathaway, it was in a difficult position. It was a declining textile company, with shares being traded at $7, while the value of its assets was at least $11. This is what we call a cigar butt, or in other words, an investment that others don't want but still holds hidden value. Buffett bought the company's shares and a few years later made a deal to sell his shares at $11.50. However, the owner tried to trick him by buying his shares for only $11.37. This not only enraged Buffett, but it also gave him the motivation to buy the entire company, and in the process, fire the owner. Now, he found himself with a failing company. But instead of simply abandoning ship, Buffett had a brilliant idea. He transformed Berkshire Hathaway from a textile company into an investment holding company, a radical shift in direction. What seemed like a mistake at first turned out to be one of the most strategic moves of his career. But what was even more interesting in this change was the new path Buffett took. He shifted his investment philosophy from buying undervalued companies to seeking out companies with economic moats. This means looking for companies with such strong competitive advantages that it would be hard for competitors to take their market share. A classic example of this strategy is Coca-Cola. Whenever you think of soda, Coca-Cola probably comes to mind, and that's exactly what Buffett wanted: brands that have such a strong market presence that they maintain their position regardless of economic challenges. So what can we learn from this? The real key to success isn't just about finding a bargain or a once-in-a-lifetime deal. No, the real key is understanding where the competitive advantages lie and investing in them. If you're only looking for where prices are low, you're risking getting into something that will depreciate over time. But by identifying companies with economic moats, like Coca-Cola, you're betting on something more secure, sustainable, and profitable in the long run. Now, returning to your situation, what can you learn from this? How can you apply Buffett's philosophy to protect your investments? Remember, the key is in understanding where real value lies, and that's exactly what Masterworks and other innovative platforms are providing: the chance to invest in valuable assets that have the potential to withstand inflation and grow. The secret is positioning yourself for the future, and this means not just looking at market declines but also looking at the opportunities forming ahead. If you're ready to start investing like a great master of investments like Warren Buffett and learn more about how to find timeless assets, subscribe to the channel, like the video, and begin exploring the opportunities waiting for you. Don't wait, because the time to act is now. Imagine investing strategically, choosing top-tier companies with the potential to become more than just good business opportunities. Warren Buffett did exactly that. He didn't just search for cheap or undervalued companies, he went further. He started buying large stakes in high-level companies like American Express and the Washington Post, using the power of his holding company, Berkshire Hathaway. And what happened as a result? Berkshire Hathaway's stock price surged from $11 per share in 1965 to over $290 by the end of the 1970s. This, of course, caused his personal net worth to skyrocket to around $240 million. Now, if you think this is just about finding good stocks and investing in them, you're missing the bigger picture. This huge increase in Buffett's fortune wasn't just the result of his new investment philosophy. What really made his wealth explode was a fundamental strategy he adopted: entering the insurance sector. This wasn't a mere coincidence or a bet on any random industry. Buffett saw something that most investors didn't: the power of insurance. What happens in this sector? When an insurance company collects premiums from its clients, it keeps that money in its cash reserves until it needs to pay out claims. This creates what Buffett called float money, a huge pool of resources that can be used to invest in other opportunities. In other words, he started investing in the insurance sector to gain access to this float money, allowing him to grow even further without needing his own capital. What's even more interesting is that this insurance strategy was just the foundation for building an empire. By purchasing insurance companies, Buffett gained access to enormous sums of money, which he then reinvested wisely. This is a completely different game because it doesn't just rely on stock market value. It's about controlling a continuous stream of cash flow, which offers much more flexibility to make new investments and seize opportunities when they arise. And here's the lesson for you: understanding where the money really is. Buffett used this knowledge brilliantly, applying his strategy over time to build the true foundation of his wealth. So, what can you learn from this? If you want to be a successful investor like Warren Buffett, you need to think outside the box. It's not just about buying good stocks or investing in profitable businesses. It's about understanding the sectors that offer not only good opportunities, but also a source of resources that can be leveraged for exponential growth. The insurance sector was Buffett's path, and it might be that you need to explore new areas that other investors haven't noticed yet. Now back to your journey. How can you apply these concepts to create your own wealth? The key is being strategic, seeking capital sources that can be leveraged, and seizing opportunities that others aren't seeing. Whether in high-potential sectors like insurance or in new forms of investment, the secret is having a long-term vision and understanding where the money flows. So what will you do next? Will you continue to follow the flow, or will you actively seek the opportunities that can transform your financial future? If you want to learn more about how to implement these strategies and start investing smarter, subscribe to the channel, like the video, and begin exploring the options that can make a difference in your portfolio. The path to success starts now, and you have the tools to take advantage of it. Business, you see, insurance companies operate much more like banks. As people regularly pay their insurance premiums, company owners generally tend to have a great amount of cash on hand. Buffett realized he could use that cash to carefully buy and invest in a series of businesses, essentially generating even more profit from those investments. Thus, since 1967, Warren started buying up insurance businesses, starting with the National Indemnity, then followed by others such as Central States Indemnity and GEICO, after tapping into billions of dollars. Imagine a business that operates like a bank, where people make regular payments but don't have immediate access to their money. This is exactly what insurance companies do. They collect premiums from their customers, and unlike traditional banks, they keep that money available until it is needed to cover claims or damages. Now imagine if you could leverage this massive amount of available money and use it to invest in a series of profitable businesses. This is exactly what Warren Buffett realized. Since 1967, Buffett saw a unique opportunity in insurance companies. He started by buying National Indemnity, followed by others like Central States Indemnity and GEICO, accessing billions of dollars from those insurers. This extra capital allowed him to buy shares in companies that he believed had an economic moat, meaning companies with such a strong competitive advantage that they would be nearly unbeatable. The most notable example of this was his purchase of 7% of Coca-Cola's stock. This strategy of using the capital from insurance companies to make smart investments caused Berkshire Hathaway's portfolio to soar. So, what did this lead to? By 1990, Berkshire Hathaway shares were trading for around $7,000. At 60 years old, Warren Buffett's net worth had surpassed $1 billion. Buffett understood that the true key to success in business and investing wasn't just about buying cheap or undervalued companies, but rather about strategically investing using the continuous cash flow from insurance companies to expand his investments intelligently and with a long-term vision. Berkshire Hathaway continued to follow this successful strategy, buying major shares in top-tier companies, including banking giants like Goldman Sachs and Bank of America. What Warren Buffett did was build an investment empire, making his company one of the most powerful and profitable in the world. And of course, he became the richest man on earth in 2008, but he still maintains a surprisingly simple lifestyle. Warren is known for driving a 2014 Cadillac XTS and often having breakfast at McDonald's. So what does all this mean for you? The most important lesson we can learn from Warren Buffett is that, instead of following the common approach of simply looking for cheap companies, the secret lies in understanding how money circulates in the market, and using that to your advantage. Insurance companies, for example, offer an incredible source of capital, allowing you to reinvest that money in growth opportunities. Buffett built his fortune based on a strategic vision and a deep understanding of the business and investment game. Now you might be wondering, how can I apply this to my own financial journey? The answer is to start thinking more strategically about where the money is flowing and how you can position yourself to take advantage of it. It's not just about having money invested, but about understanding how you can use different sectors and sources of capital to make your money work for you. If you want to learn how to think like Buffett and apply these strategies to your investment portfolio, subscribe to the channel, like the video, and start exploring the growth opportunities waiting for you. The time to act is now, and you have everything you need to build your own fortune.